Leverage ratios measure the amount of capital that comes from debt. In other words, leverage financial ratios are used to evaluate a company's debt levels. Debt ratio measures the relative amount of a company's assets that are provided from debt. Debt ratio calculates as total liabilities divided by total assets. In general, many investors look for a company to have a debt ratio between 0.3 and 0.6. From a pure risk perspective, debt ratios of 0.4 or lower are considered better, while a debt ratio of 0.6 or higher makes it more difficult to borrow money. Let's calculate leverage ratios for a given company. So the debt ratio in this case scenario will be total liabilities divided by total assets. Filling it to the right, and we see that debt ratio is from 0.2 to 0.1, which is pretty good and gets better over time. Debt to equity ratio calculates the weight of total debt and financial liabilities against shareholders' equity. What counts as a good debt to equity ratio will depend on the nature of the business and its industry. Generally speaking, a debt to equity ratio below 1 would be seen as relatively safe, whereas ratios of 2 or higher would be considered risky. If a company has a negative debt to equity ratio, this means that the company has negative shareholder equity. In other words, it means that the company has more liabilities than assets. In most cases, this is considered a very risky sign, indicating that the company may be at risk of bankruptcy. Let's calculate debt to equity ratio, which is our total liabilities divided by shareholders' equity. And we can see that debt to equity ratio is less than 1, which is considered as safe. Interest coverage ratio shows how easily a company can pay its interest expenses, and it's calculated as operating income divided by interest expenses. Generally, an interest coverage ratio of at least 2 is considered the minimum acceptable amount for a company that has solid, consistent revenues. Analysts prefer to see a coverage ratio of 3 or better.